So we do have not only the press release, but we also have the summary of economic conditions here. Now, I think this is on GDP right here, Matt. But I don't know. Oh, we got unemployment right here. We had it right on it. Now, there's also obviously showing ranges, and I believe this is also this is the opinions. Yeah, this is the projections from all of the board members of the FOMC. And so you can see the median, the central tendency of the projections, and the range of projections. So just we're talking about unemployment. They basically have it at really 2024 is the widest range. They have it ranging basically at the peak just above 5 all the way down to 4. So between 4 and 5. And then they have it, declining after that. But the current unemployment rate, right now is, what do they have it at? Is it 3 in the dot, 3.25 nationally, Matt?
It looks close to 4, maybe.
Kind of hard to see on that. I don't think that.
What's interesting also about this chart here, I mean, all of their projections, even the low end, are slightly above. We're going to end up slightly above where we are at now in terms of unemployment. Like it's going to get I think the unemployment is very tight right now. And I don't know do they have a percentage goal for unemployment like they do with inflation?
Yeah. So that's what I did. So the goal is, maximize employment. For employment. No, that's, I think, a little bit of a loaded term, but I think 5% is like kind of typically an okay range.
And that's what I thought too, as a rule of thumb.
I think they'd like it to be they'd like it to be as low as possible without causing inflation.
Okay.
Is what they would really like to see. I think between 4 and 5 is typically pretty good, really good.
And then
not
the
10% like it was.
That's true.
GFC.
And the maximum of even the most pessimistic projection in unemployment happens in 2024 at a little over 5. And so all in all, the unemployment should stay within normal range. Now, here's another thing about unemployment is it's a little bit of muddy waters right now. I'm not sure because of how all these hirings and firings are. And then you hear on one end, people looking for jobs, they can't find jobs. On the other end, you're hearing about people, jobs not getting filled. So
if anyone tells me that they're like looking for a job and they can't find a job, the tips typically it's like you're looking for jobs that you are like vastly unqualified for, or you're really not looking that hard. If you want a job, you can get it. It may not be like your ideal job, but like if you are someone who needs to make ends meet, there's some opportunities out there.
Yeah,
might not be doing what you want to do, but there's options. Looking at the dot plot, Matt, this is looking at the Fed funds rate, and this is each little dot represents the opinion of FOMC, Federal Open Market Committee board member. So they see we have 2023. Where we're going to be at the end of 2023.
Okay.
It is now all above 5, folks. Only one member has it just below 5, but pretty much everyone is at 5. The highest dot, there is one dot just below 6%. Now, sorry, go ahead, Matt.
So the vast majority, the median for the peak of this year, would that be at 5 or 5.25?
I don't know exactly what the median is. I mean, the consensus here is everyone's got it just right above 5.
Okay.
So I guess right in the line is 5.25. So just below 5.25 is what they're saying. Now after the end of this year, going to 2024, decent amount of consensus that the Fed funds rate will decline. But we've got a range all the way from just above 5.5 all the way down to just above 3.25, with the most members having the Fed funds rate right above 4%. So that would be lower than things are today, because I think we're based on the 4.75 to 5% range.
Think about
right now.
I mean, the way they project it seems like we'll lose maybe 1% a year on the way down. We gained 4 or 5% on the way up.
Yep. And that's right in line with their projections for GDP as well, not to jump around, but the GDP projections at the end of this year. Sorry, no, we're talking about the same thing. The median Fed funds rate, 5.1 at the end of 2023, 4.1 the end of 2024, 3.1 the end of 2025. So they're just 100 basis points a year taking down in the Fed funds rate. And, there's a lot of correlations between inflation and rates, and maybe we'll see a similar type of reduction in inflation. I think that would be the idea. But, moving forward in their long run view, so this isn't necessarily 2026, which The year before that, in 2025, the highest, there's a single dot, which is a couple hundred basis points away from the next highest, right above 5.5. But the rest, the next highest is just above 4.25, with the lowest being just above 2. So a wide range, with the majority being just right around that 3% range.
I'd love to be able to highlight these dots and know which one of these Fed members.
Well, sometimes you can, if you know the personalities or, how hawkish or dovish, like I bet you could probably I'm not the one to ask, Matt, but I bet someone you could probably figure out
based on
this outlier of in 2025, who has it still at 5.5. But that shows, there's like a decent amount of consensus in the near term, but there's some folk, there's a wide range. 24, 25. Now there is more consensus over the long run. Pretty much everyone's at 2.5%. But you still have some, you got 3 members that say that Fed funds is still going to be 3 to, above 3.5. So it shows that, 1, that we don't know. 2, it's going to take longer than, would be ideal.
Can we check out the GDP? I think it's a little bit before the top plot.
Well, yeah, I think we had just skipped over it. Yeah. Changes in real GDP. So they're projecting essentially, Matt, is a kind of a slight tick up of GDP, but to be relatively sluggish. Really, but this year it's between 0 and 1% ish, and then it's going to rise slightly to be also maybe just a couple basis points to being 1.5%. In 2025, they're thinking it's going to be a 2, and that is, we'd really like to see GDP between 3% if you got inflation closer to 2%. This is still, I'm describing a scenario where inflation is running hotter than GDP, and we may have a little bit of a stagflationary situation, especially if unemployment rises. The one thing that stagflation isn't a pure, there's no pure definition. It was something that was made up in the 70s. We've talked about high inflation, lower growth, or high unemployment. We don't have the high unemployment, but we certainly will have high inflation and low growth. And frankly, we are experiencing that today.
And that's the biggest gap, or the biggest area of uncertainty, seems like their projections for the unemployment rate this year among all the different ones. But I guess the outliers, the central tendency of projections is the largest when it comes to that.